Thank you so much, Juliana, for the introduction. Hello to everyone. Thank you so much for joining me today. For those of you who tuned into my segment during IDC University Days, or to those who missed it, and to get everyone up to speed, I shared a more personal story during that presentation, sharing how growing up in a household with a business owner parent, I've seen firsthand the far-reaching impact of not getting optimal advice. It doesn't even have to be bad advice per se, but even the impact of suboptimal advice versus getting great advice from an advisor who took the time to truly listen and understand to know what, my mom's story is and what was valuable to her, and be able to provide genuine value back instead of just pushing a product. So today I want to go further down that path of truthfully, not going just into that product pitch that, we usually do a little bit more. What I've drawn from the Stories That Sell theme is that we want to show that we could add meaningful value and to make deep connections. So for today, we're going to focus on conversations that we can have and that we could start with our business owner clients around their will. So we're not going to get into the legalese or to technicalities. We're going to focus on the conversations that reveal what's truly important to your client or perhaps to a new prospect that you just started working with, how to enhance opportunities for a personalized and most likely much more robust insurance solution once we understand that client and what matters to them a little bit better, and deepen the relationship to give you the right environment to create your own stories that sell. Why is the will conversation an important one to have with your clients when you are an insurance advisor? You might be thinking, why should I go down this road? I'm not a lawyer, Anna. I can't offer legal services. And truthfully, and you wouldn't be wrong, I can't make revenue directly from this. And that's where the power lies, truly, because your client also knows that you wouldn't make anything directly if you're talking to them about their will. So it is very disarming. It shows them that if there were any hesitation that you, in the end, you're an advisor, but you're also a salesperson, that maybe you're just trying to sell them a solution. By you really valuing and prioritizing having their will and their estate plan created, up to date, in place, knowing that there is no, for example, direct sale or profit to you, you're not the one putting it together for them, it could create a really meaningful shift in the perception and advance your relationship with this client further. It's almost always a shoe-in for a value add as well, because there's a very high chance that this is a need that needs to be filled here. So if you look at the numbers on stage from 2019 survey on Canadians that have a will in place, the numbers aren't great. Only 55% of Canadians have that will in place to begin with. So this tells us almost half of the entire Canadian population has not put together this extremely important puzzle piece in their financial picture. Not noted here, but when I went into the study that we drew this from an Angus Reid study, I wanted to look into the numbers further. And what it said was, of that 55% that did put that will in place, so look at them as a standalone pool, it's already just over half. Only 35% of those have an up-to-date will. So that means factoring in updating it since they've started a business, or perhaps since they've grown their family, made any other changes within their family, maybe they bought a property in the meantime. They may not have updated it to include some of these really vital changes that have been made. So half of all Canadians are set to have no say in what happens to their assets when they die. And of those who did actually put a ball in motion at one point in time, the majority of them may still not have their wishes met due to a lack of updated planning. Now, those numbers are even more sad for the under 35 set, where almost 80% of this group does not have a will at all. Now, back to what I said earlier about bringing this up being a near shoe-in for a really valuable value add truly for you. I had a very experienced advisor tell me before that when he brings up the will, it's kind of like being a dentist who brings up regular flossing. Now, work with me here on this analogy. So, yeah, you'll have the half that could smugly say, yes, dentist, I do this absolutely every day without fail. But of the half that don't, what you're usually going to hear back is the, I know, I should, I will, I must. You're generally not going to get pushback because it's something universal that everybody knows it's important. It's a must. And if they're not doing it already, they know they have to. So they're not going to give you a hard time for reminding you of that. And with enough goading, maybe they'll make it into a routine. And one day down the road, they'll be so thankful that this was introduced, positive outcome for their health. So this advisor who showed me this analogy went on to say, this truly is like bringing up a will to someone who doesn't have one. You usually get that same kind of response back, I know, I really should, I've been meaning to, I've been putting it off, I know it's really, really important. You're almost never going to get that pushback from the majority of your clients. They're going to be thankful for the reminder. We all have this embedded cultural value as Canadians that every adult truly should have their affairs in order. So, like that dentist, you may think one day for keeping on top of you for having the healthy habits, and they're not afraid to annoy you about it. Be the advisor who consistently reminds their clients and ensures that they saw through that their clients put their will in place because they will thank you for it. And as someone, I personally worked with an advisor who truly always pushed for up-to-date planning, for very thorough planning, for having wills on every single one of those clients. Even if it meant delaying the insurance sale, it was top of mind to make sure those wills were in place and up to date. I can wholeheartedly vouch that once your client feels that mix of relief and having completed something so important, which inevitably will happen, they'll feel that relief when it gets done. They will thank, value, and respect you as their advisor for pushing them to do it. And that's sharing some of my personal experience there. So onwards, now we know the most basic reason we should all talk about it. One, there's that colossal need, as we see in the study of recent one here. And two, your clients will respect you for bringing it up and pushing them to get this done, I promise. So with that, let's move on to today's agenda to cover what we're specifically going to talk about and how it helps you as an insurance advisor. So today we're going to go over the basics of the purpose of a will, followed by a simple estate planning process chart for a business owner. Next up, we're going to go through what I feel is the most important part to getting these meaningful conversations going, getting clients to open up about their stories, and the personal and business questions to ask our prospects. Last but not least, we're going to go through a case study that centers around conversation starters and what information we can glean from them. So once again, we're not going to get into any product today, truly, but during the analysis, the simple questions we could ask to uncover wants and needs, we'll see how it really does enhance available insurance solutions. So a will is a legal document that says how you want your estate to be divided once you die. Your estate includes what you own, so your assets, and what you owe, so your liabilities. An up-to-date will can help your estate representative deal with your estate when you're no longer there. Provinces and territories are the ones that set the laws for estates. So you're not legally required to prepare a will. However, if you don't have a will, the laws in your province or territory will determine how your estate is divided. So this is called dying and testing. There are so many simplified ways of how to get a will together online now. However, with a business owner, it is a very good idea to get professional legal help, especially if their business is a little bit more complex or they have multiple companies, for example, holdco, opcos operating together. It is beneficial to be working directly with a lawyer. This will also help make sure that all the documents are prepared and witnessed appropriately and include the complexities and the nuances of what happens to the business itself upon death of the shareholder as well. So you would be dealing with a personal estate, but as well as the shares of the business as well. So it does get a lot more complex when we're talking about a business owner. Now, a will represents the most fundamental element of an estate plan at its core, and it serves two basic purposes. So number one, it names an executor, or for those in Quebec, a liquidator, who may be a person or more than one person, an institution or a trust company that's responsible for carrying out your wishes and distributing your assets that pass through your estate after death. And next, it ensures your property will be distributed to your beneficiaries in accordance with your wishes at minimal expense and minimal delay. Now, as mentioned again, if this isn't in place, it is up to the laws of your province or territory to decide what happens when you go with all your hard work. So, very important thing to remind our clients about. Now, while advisors are not the ones preparing the will, they are having a conversation around estate planning. It's at the crux of what we do. And of course, positioning financial solutions that can accomplish the client's estate objectives. Life insurance often provides the funding piece for what our clients' hopes and goals are. The dream could be to leave one's family a certain amount, for example, or to have your business partners pay out your shares or buy your shares from your estate, I should say, swiftly and smoothly. So it's headache-free for everyone, both your family and for the surviving shareholders. For many, it's a charitable bequest. They have charities that are near and dear to their hearts. Insurance could provide the funding for those dreams, right? All dreams need money. We know that. Anyone with kids will definitely know that. All your kids' dreams need money, so you know that very well. Same thing happens with our clients. And by knowing what our clients' wishes are, we can help put that funding portion in place. So although today's topic is about opportunity spotting centered around the will and the will conversation, we should review the steps of estate planning as well. So for a business owner, preparing that inventory of their assets and liabilities is a really good first step. So that would be their balance sheet. Next, defining their estate planning objectives and priorities. So this should look different or at least personalized for every one of your clients or prospects. And this is where a lot of your conversation is going to center around. This is where you're going to spend a lot of that conversation time. Next, evaluating those objectives based on current financial situation. So referring back to step one would be really important here. And as we'll see later on, when we talk about fair market value, this might involve help from other professionals in our business prospect lives as well. Next, determining which actions are necessary to achieve those objectives. To state the most topical one that we're going to be discussing today, putting that will in place, for example, is something that we could stress and making sure that it's up to date. Next, consulting the appropriate advisors to implement the components of the estate plan. So for example, very basic here as well, having that lawyer draft their will or to set up any needed trusts, bringing in accountants to look at possible long-term tax needs, discuss too, perhaps in some situation an estate freeze could come into play here. So we're often not going to go into this with our client alone. We actually want to tell them right from the get-go that we want to work with their other professionals. We want to meet their lawyer. We want to meet any wealth advisors that they have, their accountants, if they belong to a family office, for example. This should be a process where we all come together to work together, to collaborate. And next, periodically reviewing that plan. This is not a set it and forget it. There's definitely a degree of relief when you get it done the first time around, but just as our clients' life situations change and go through different stages, so should the estate plan as well to reflect current life needs. So let's get a little bit more granular when it comes to what questions we should be asking, right? What are some of the exact questions we could ask a client to get them thinking about this process and in turn reveal to you A, what's really important to them, and B, what do they have to protect? This is going to be number one for us as insurance advisors. So we're in the business of protection. We need to know what risk we want to help them mitigate. So to get into some of these questions here, who will be the beneficiaries of the estate? Who's in their life? Is it a spouse? Is it perhaps a second marriage? Kids of their own? Will there be stepkids? Are they looking after an elderly parent as well? Are they part of that sandwich generation where they want to know that if something were to happen to them today, they might even have parents in their lives they want to take care of? It's going to be a big one. What impact will the estate plan have on your family? Maybe they have something in place now, but they might have gotten remarried. Now there might be stepkids, for example. So the impact of the plan they have in place now might not go over too well when you consider their current life situation. For how long do you intend to provide support to your immediate family? When I first started in the business, I always was taught, for an F&A, financial needs analysis, you times your salary until the kids are 18 and then off you go. Having that responsibility until 18 is a little bit of a thing of the past. We don't see that as much anymore, and it could mean different things to different clients. Some might still hold on to that, but some might pick another age, 25 or even beyond that. Are there any significant family assets that you would need to be addressed? For example, maybe a cottage that's very meaningful, or a rental property that everyone in the family has managed or interested in managing. Is minimization of income tax and probate taxes important? Now, you might think this is a no-brainer, but this really does mean different things to different people. Some are really dogged about paying as little tax and little probate as possible. They're very passionate about that, and they'll do everything to plan around that. For others, they say, you know what, I'm a bit more lax. I just want to take care of my family first. Next, do you want your beneficiaries to receive their inheritance immediately or at some future date? We have a phrase in our industry called a spendthrift beneficiary, which means they can't be trusted with money. One of my coworkers always says something cute, and he says, if something happens to him today, his daughter's going to make investments with the face amount, with whatever death benefit gets paid out, and his son's going to go buy a Ferrari. And he just knows this is exactly how it's going to work out for them. So our clients would know that about their own beneficiaries and might want to set some staggering in place to receiving some of the assets from the will or from an insurance plan. And do you wish to leave any portion of your estate to charities? This is where we get them talking a little bit more about any charitable bequests, what's near and dear to them. And very importantly, do you have any beneficiaries with special needs? Get them to open up. Is there someone in their life with a special need that will need extra attention, extra care, and truthfully, extra liquidity and extra assets to make sure that they have the best quality of life? Now, these are some of the basics we should cover with nearly every client and prospect that we come across. Next, we want to see what kind of opportunities we can draw out to do what we do best as insurance advisors. Now, when we look at life insurance needs analysis at F&As, we can remind ourselves of what we are looking for when asking discovery questions. But I'll just touch on a few of them that are on this slide here. Final expenses is one of the most obvious, so we don't have to go too far down that road. Everyone needs something in place. I often get brokers that say to their clients, a GoFundMe is not your final expense plan. Everyone needs something in place, every adult. How about debt? This will be a big one for a business owner, as commercial debt is usually much more robust than personal debt. It typically doesn't take a lot of arm twisting either to get a prospect to see the importance of having this covered in case the worst should happen. Next, probate and taxes again. Do they know how probate works in their province or territory of residence? Are they familiar with deemed disposition and overall what happens with taxes when you die? Our clients might be absolute experts at what they do for their own business, but many may not be familiar whatsoever on deemed disposition or what probate looks like in their province. This is a really big place where we could value add and show them what would happen, because then it shines a light on how to plan around it. Usually they're very surprised to find out about how deemed disposition works. Next, potential conflicts amongst beneficiaries. For example, a blended family or a second marriage. While we might not have a dollar value to associate with this need, life insurance and or owning more than just one policy could be a very worthwhile solution to prevent conflicts amongst beneficiaries with different needs and different interests. For example, there might be still some obligations from a previous marriage, for example. This also further strengthens the need for a will and an updated one at that. Our clients may remarry, and due to factors such as, for example, joint tenants with right of survivorship, properties that they have in a newer marriage may pass on to that new spouse automatically. And when they intend to have that asset go, let's say, to children from a previous marriage, they may not know that if they have that property with as joint tenants with right of survivorship, it would automatically go to that new spouse who doesn't have any legal obligation whatsoever to give some of that value to children from a previous marriage. It's up to us to provide that value and tell them, and even more important, to show them why they need that will in place. So great opportunity as well to talk about insurance when it comes to estate equalization as well. Speaking specifically also about business owners, when we do that financial needs analysis, we have to look at the balance sheet of that client. So what do they own? What are their liquid assets? What do their illiquid assets look like as well? Many business owners may be asset rich, but cash poor. But upon death, the business and those in it and their family might really need that injection of cash to manage their affairs. Next up as well, what do they owe? What wealth or net value do they have overall? What, to whom, and how are they providing upon their death? Who have they identified? And we've brought this up a few times at this point. How do they want to provide for them? What in particular do they want to leave behind? And also, we need to show them what will trigger different tax situations. For example, here, we could introduce them to the concept of perhaps an estate freeze and crystallization, really getting their accountant involved to see if something like this would be beneficial when they're doing some of their tax planning for leaving their business to perhaps the next generation, or at least tax planning for it. We can only make these valuable suggestions only after we ask some of these initial questions and truly listen to what they have to say. So let's talk through some of the questions to ask a client, whether or not they happen to be a business owner. So don't forget that business owners don't just have that business to think of. They also have a family and personal needs, most likely as well. That being said, we will be talking a little about how the personal and business situations connect with each other. We're going to revisit some of the questions that came up earlier, why they're important, and what green flags they raise for us as insurance advisors. So the most basic, no one's going to be surprised by this one. Do you have a will? If they say no, this is a really good opportunity to connect them with this solution. As I said, you get to be, the dentist asking about the flossing there, to use that analogy again. We get to be annoying about this. Do not be intimidated to ask this question and to keep reminding them of how important it is. As I mentioned before, huge value add, and they'll thank you for it. Next, if they have one, is it updated? When was it updated? Very important as well. Don't let them just get away with, I think it was a few years ago. And then you ask when, and they start doing the math, and it's like, it was 12 years ago, for example, right? Or maybe 20 years ago. Time flies. Maybe they were married at the time, but they didn't have kids yet. Now, all those years later, they might have, 3 kids. One might really be interested in their business, but now the business might have a really big capital gain because of how much it's grown. This may never have been considered when the will was updated last, and overall, it might have been a complete non-factor at the same time. Does that will fit now? Now that they're talking about their goals for wishes after death, do we see any inconsistencies for what they want and how their assets are set to be distributed? This is a great place to segue into the insurance conversation as well. If we're asking about, is the will up to date? It would absolutely be in line for us to ask as well if the insurance is up to date. Now, this might be a referral to you. You may not have been the original advisor on file, and you want to build some rapport first before asking, if you've earned the right to take a look at their insurance portfolio. It would definitely be appropriate at this point if we're asking if the will is up to date. Well, what about those insurance plans as well? Because there should be some really great synthesis between the will, of course, and any policies that are in place. So you get to ask for that review here. It's also appropriate to ask so we know what beneficiary designations are in place. Do they match the bequests of policies in the will? And if that overall matches the desires for asset distribution, especially if insurance is going to be used for funding or if it's going to be used for estate equalization. So these are the two basics. Do you have a will? When was it updated? Showing them the importance of both. Moving on to family questions we could ask. Do you have children? Then, with just one simple request, the next statement, tell me about them. That could be an entire meeting alone. And sometimes that's the conversation that really deepens the relationship to a level where it hasn't been before, especially if family is very near and dear to this prospect that you've come across. Asking, how old are they? Getting to know, are some minors? Are some of them adults? What are they up to? Will they need financial support if something were to happen to your client? For how long? This is a question we touched on earlier. The answer might surprise you. Things have changed from in the past. I know clients funding their adult children well into their 30s, helping out whether it's their down payments, oftentimes fully funding their mortgages, daycare for the grandkids. For those asking, it's because I live in the GTA. I live in Toronto, so I do come across, not just saying my personal life, but even applications where I see in the advisor's report, grandparents need this much because they have kids in their 30s, sometimes in their early 40s, and they're still helping with the mortgage and making sure kids go to daycare or private school. So asking that are they currently in a position where they feel they have to help their adult children because they likely don't want the well to run dry if something were to happen to them. So it's an easy insurance conversation, of course, and it's not just for the minor children, as we can see here. If we don't ask and listen, we may not see that need because we might just assume because there are no minors that there aren't financial obligations or a need for support that still exists there. Now, how about the question, do you want them to work in the company? Or the flip side of that is, do they want to work in the company? Is there any interest there? What I come across personally, and I'm sure you do as well as an insurance advisor, maybe more mom and dad want their kids to work in the business, but the kids aren't too sure yet if they want to or not. So get that conversation going. For example, what if you needed to equalize an estate? I had a broker come across a client that owned a fishery. He had 3 kids, I should say. One was a doctor, one went on into the legal profession, and one became an artist. None of them wanted to fish. However, he had a nephew who absolutely loved what his uncle did. He absolutely wanted to take on the business, and he was truly a worthy successor. And this business owner wanted to pass the shares to his nephew. But the business assets were about 70% of the assets in the will. It was a predicament that was really easily solved very neatly with life insurance to help equalize the estate. What he wasn't able to split in a way that he found was fair and what was equal amongst his current assets, he was able to support with some life insurance as well. Now, the next question is a little bit more sensitive, but if someone is in the position to ask, of course, it's us in the insurance industry, as this matters to what we do. We just have to be sensitive with our delivery and our timing. And that question is, are there any health concerns amongst your children? Or perhaps another way that you would like to phrase that for that particular client or that particular situation. So for example, when it comes to their assets, When it comes to RSPs, they could receive special rollover treatment to a dependent child, even when they're an adult. For example, one with special needs. And the client may desire maybe like a special testamentary trust where the RSP can be transferred without taxable disposition. Now, with their other professionals, it may be determined that, this is the most optimal way to handle some of the RSP assets when it comes to tax planning. But then it could trigger the question of leaving assets from a life insurance policy to the other children for the sake of equalization as well. Now, of course, the most obvious needs when we're in a situation like this one is providing a source of funding when that parent is no longer there. Now, another caregiver would have to come into play, whether they're a relative or not, and liquidity to ensure quality care and quality of life are extremely important here. So I know it's a sensitive topic, but it reveals a lot about what our business owner would like to plan for their family, the levels of support they leave behind. And here's a chance we could really make a really meaningful impact for someone who is in that situation. And it all starts by asking that question. Next up here. I really like this RSP question as it often gives us a chance to provide value. As it's a tool most of our clients have, very common for most Canadians to have an RSP, but might not be aware of what happens to it when they die. I often hear in my personal life from brokers chatting with clients, I'm going to pass my RSP assets to my kids. And our clients are not aware that the government will absolutely come for their pound of flesh, even if they think that this is how they're going to pass it on. They might be able to pass on the value of the RSP, but that tax that will be owed, that they 100% must pay, will be coming from their estate. They're not gaming the system by having the RSP go directly from their kids. The government will come and they will collect. They'll just take it from the estate instead. So unless it's a very special circumstance, like the one we discussed in the last slide, for example, a special needs child that is considered a dependent, an RSP can only roll over to a spouse in a truly tax-free way. Well, what if it's a second marriage, perhaps a newer second marriage, and there are adult children? Our client really wants to prioritize here. They've saving up those RSPs for most of their life. They want their kids to get most of those assets. Now, the tax-free rollover to the spouse, so this new spouse, may still be the most optimal way to handle it when it comes to a tax planning perspective. When they look at different ways to pass it on, let's say to the kids instead, and they view what could be lost to taxation, it might still sometimes be the best bet to have that rollover tax-free to their new spouse. And if you're thinking while hearing this, this is an excellent way for life insurance, yet again, to be used as an estate equalization tool, you would be absolutely correct. Actually, there's a fantastic case study in one of the CLU materials that walks you through something like this, that says, these are the RSP assets. This is what it looks like if you split it amongst, your adult children versus your new spouse, or let the new spouse get it tax-free. This is how much it costs to put something permanent in place for the 3 adult children. It's worth keeping everyone happy, both fair and equal at the same time. So we've covered some of the more warm and fuzzies and more of the personal questions that could apply to all our clients, of course. Let's move on to asking more about our client's business in particular. So some of the most basic but greatest questions to ask, of course, are, how did you start your business? Business owners absolutely love sharing about how they started their business and what it took to grow to where they are. You want the story, you want them to open up, you want them to paint that picture for you of how they began and where they're at now. For example, are they proud to have started from scratch? Did they purchase the business? Did something catch their eye and they decided they're going to go and they're going to make that acquisition, they're going to buy it out? Maybe they inherited it from parents or relatives, so it has that, warm and fuzzy legacy component for them. Of course, we want to know about our clients, but for you as an advisor, it also kind of gives you an idea of what the ACB could be tracking like. For example, if they started the business from scratch, from absolutely nothing, and they are very successful today, we could be looking at very large capital gains. Now, giving you a hint of how important the business is to the client and the correlation of the fair market value, is it important to keep that kind of value growing even after the business owner is gone? So, for example, do they want the business to be something that lives on after them? That's not always the case. Some say, you know what, my kids are never going to be interested. It was good while it lasted. This was my passion project always. Whereas others say, I've worked in the business and I've also worked on the business. I created something that exists outside of me. Of course, I want it to still grow when I'm gone. This is a project that's outside of me now. I want it to keep going, and it means so much for me to leave that legacy, whether it's in my family or not. So, what are things we can look for as they speak, and ask prompting questions, of course, to get them to elaborate? So, for example, again here, did they increase the business by acquisitions? Has there been an impact of the ACB and market value to the final shares because of this? It's a great question to ask. First, look out for, then ask. Is the value set to increase in their perspective? And by how much are they thinking? Of course, this is all ballpark, but we get to ask, are they taking on any more contracts? Are they expanding? Are they buying a new building? Are they buying a new warehouse? Do they plan to open up new branches, buy new office units? Huge indicators if they expect a lot of growth or not. Of course, if you have increasing value, you also have increasing capital gains. We can try to find out if there's going to be a large tax bill from hearing the story, once again, of the growth of that company. But also important to listen in for, who are some of the key players? For example, when they're telling you the story of growing and expanding the early days of versus today, have they said something like, oh, and today I finally get to take more vacation time because of this person that started in the business, or this person that just joined on, they've been so instrumental. The alarm bell should be sounding right now when it comes to key person insurance. Sometimes you don't even have to ask, do you have any key people in your business? Just listen to them share the story and look out for those hints, even if in their lifestyle of what it looks like today versus the early days in the business. At this point, having shown that we do care enough to get to know our client as a person, to get to know their family situation, how they build what they have, we can get to a point, or likely would be at a point now, whether it's in the first meeting or the next, where we could be a little bit more forthright and ask, how much is your business worth today? Granted, sometimes the client doesn't know, or they might just have a rough ballpark at this point. But at the same time, many may also have gotten more sophisticated tax planning by this point. Perhaps they've also gotten a valuation. This would be a good time to ask so that you know if that's happened or not. Pointers that we can share with our clients now that we're talking about FMV, fair market value, is that the value of their business could drop with the death of an owner or a key employee who is responsible for bringing in a lot of that revenue. If it really does center around certain key individuals, what does it look like for the fair market value of the business if that person suddenly couldn't be in the business anymore? We can help offer protection there. What about their plans for a possible non-arm's length transfer, for example, to one of their children? They may not know that a transfer to a family member would be considered, tax reasons, to have happened at fair market value. Regardless of the price actually agreed upon, it's still going to be looked at as having been sold at FMV, even if those funds wouldn't be received at the same value there. They're not going to escape what's owed to the CRA this way, but we could show them that with insurance, it can and it will cover what's owed by having that in place, plus support the value of the business after death with, for example, a cash injection that could bring on the right people, allow the surviving shareholders to bring the right people into the business, and it provides that much needed liquidity for taxes, for example. for just pennies on the dollar, right? Although my focus is on the life side of the business here, this is also a really easy segue to ask about the impact that FMV would experience, in their perspective, if there was a critical illness or perhaps a disability of an owner or maybe a key person, and what that would look like for the business. Could really open up the living benefits conversation as well, along with the life as well, pardon me. Next up, who will receive your shares? And what would you like to see happen with them if you are no longer here? So our business owner also has shares of their own private corporation. Now, this is important to keep in mind. They don't just own a business, they have shares of a business that they have to plan for. So questions we need to ask are, of course, who are you planning to receive those shares? And overall, how do you expect your estate to be distributed? If one's heirs are their children and they are minors, well, what's going to happen with the continuation of the business, for example, right? Those minors just can't step into place and take over for mom and dad. What happens to the business? What happens to their employees? Really important question here. What is the contingency plan if you can't go into work tomorrow? Do you have a contingency plan? Does the most important person in your office or your warehouse or anywhere in your business know if you don't walk in tomorrow, what happens next? What are the very next steps? Really important to put in place here. Is the state considered, the state is something we consider, but what about the continuity of the company? Are there other shareholders involved here? Now, there's lots of very juicy and probing, revealing questions that we could ask here. And the answers we get might reveal insurance needs, for example, to, once again, what happens when it comes to covering taxes. Number 2, look at key person insurance for those key players in the business, including themselves. Number 3, do they have the capital or will they need the capital to bring in the right people into the business to preserve continuity, to keep the business growing, and to keep those employees employed? It's what we mentioned a few slides back. Is this business that they see something outside of themselves that they want to continue to live on? Maybe they've worked with those employees for decades and they can't imagine, just having it go belly up if they can't walk into work the next day. So this is going to be very revealing about what's important and what they have to protect. Next up, how will the shares of the business be transferred, right? We've talked about, to who do they want to see it go to, but the question is here, how? First, we hit them up with absolutely needing a will, no ifs, ands, or buts. Now we're going to be hitting them with needing that shareholders agreement. I shared those abysmal stats on the updated wills at the beginning of the presentation. I tried finding stats as well for how many business owners have updated shareholders agreements, and I wasn't able to find a reliable source for Canadian businesses. But I work with brokers constantly who come across clients that either simply don't have one in place at all or haven't updated it in so very long that it's lost any of its effective value overall. So this is the next big thing that we could hand them on and that they're going to really appreciate that we do. Once again, do not be intimidated to bring this up and to really be on them about it, because just like a will, it's not you who has to go through putting it together. So if you feel you're not really strong in this area, that is okay, because what we want to do is bring in their other professionals and collaborate with them. And it's going to be their lawyer that we would need to consult with to help put it together. But you are the one that could put in place that really important funding piece. Now, their business value can skyrocket over the years, but nobody knows the date that might be the last time they ever walk through the doors of their business. That's something none of us can plan for. We can't time that. But we know that when it does happen, a life insurance plan in place that funds an appropriate shareholders agreement ensures the funding will be in place for those shares to be purchased. And once again, I am the life specialist here, but something that is often overlooked when it comes to shareholders agreement is funding when it comes to disability. Not even just the funding, even bringing up what happens if one of the shareholders becomes disabled. Is there a clause in there that says, how long they're going to stick around the business before they get bought out? What happens to the distribution of work? Is everything going to be considered equal if they're disabled for a certain amount of time? This is something that absolutely should be addressed in a well-positioned shareholders agreement as well. Now, onto our case study. I should mention it's a little less of a traditional case study, as today's presentation was all about the soft facts. Case studies tend to focus on generally hard facts and sorting through them together. But what we want to do here is hear the client's story. I know I must sound like a broken record when it comes to this, but truly it's because facts tell, but stories sell. And hearing a prospect's story often gets them to sell themselves on what they need to protect and what they've worked so hard for, right? We're not just gleaning information for ourselves. We're getting our clients to think about what means something to them. And often just through the act of sharing that with someone else, to talk about how important their family is, to talk about any special needs someone in their family has and how important it is for them to take care of them on an ongoing basis, whether they're here or not, to talk about the starting days of their business, whether it was grinding it out and starting it from scratch to where they are now, or maybe they purchased it from a relative because it's something that they've always loved. By bringing up what's emotional to them, what's meaningful to them, that alone kind of sets the stage to themselves. Like, this means so much to me. I should really protect it. It's a really good thing I'm sitting in front of an insurance advisor. So let's go over the below here on the slide. Maybe, let's imagine that this was a referral. They've given you some overview of what these clients look like. However, it's not going to stop us from wanting to hear those facts again from the client. Even if you know them, even if they're existing clients of yours, but you've never probed this deeply before into, their life story or their history or the history of their business, this is a really good time to ask those questions again, get those conversations going, and get them to really open up to us. So we have an example here of a lumber business. Their fair market value is at $7 million. We have two spouses that are equal shareholders in their 50s. They have 3 children. One's a minor. 2 aren't currently in the business right now, but 1 child is possibly interested. They are all Canadian residents, so we don't have to worry about any taxation from another country. They're doing well for themselves, obviously with the $7 million business. They also have personal real estate assets of $3 million. They also have individual RSPs at $500,000 each. And the will was done when they were married. So we see here it does not include them having children at this time. Perhaps the real estate assets were at a lower value at that point as well. There's a very good chance the business was at a lower value, or even was the business even around when that will was first put into place. And we know that securing the estate and avoiding family conflict is very, very important to them. Now, seeing the scenario here, what questions would you ask considering the above here on the slide? When we think about it, what stood out to you the most that you would want to probe more on first if you were introduced to a referral like this? Now, if there are referrals that we don't know personally, we might feel more comfortable asking open-ended questions about the business. So before we go and wade into the personal side, maybe we just met them. Most people are going to open up about their business a little bit more. We could get them to start, set the tone there. How was your business started? So simple, but it's a really good one. This one sets the stage for discovery on what kind of capital gains could lie in their future. These are the hints that you're going to be looking out for as an advisor, as a likely talk about it. For example, once again, maybe I started it from nothing. Maybe I inherited it. Maybe I grew it from acquisitions. sets the stage again for that insurance conversation. You get to tell them about how capital gains works, how deemed disposition works. This could also segue into it being appropriate to ask, how much is your business worth today? Besides the hard facts around that answer, here we already discovered it's 7 million. We get to focus on those soft facts. They just told us earlier all about how they started their business, because that was our first question, and what they grew it to. We've set the tone now to allow us to ask appropriately, how would your absence impact the business? Right? It's a little bit more morose to talk about them not being here anymore. But if they just talked about how much this means to them and the value that it has now, it would be an appropriate time to ask, well, if you weren't here tomorrow, like where would that leave us? If they've mentioned a key employee, once again, in the business's growth, like during that story, how would their absence impact the business? What would that look like? We've just walked them right into the right mind frame to showcase, for example, in this position, key person insurance as well, and why it's meaningful. Tell me about your children is going to be a really big one here. We want to know their ages. Are there any minors? Are they still in school? What are they interested in? For example, are any of them interested in what mom and dad do? What about their health? A little bit more sensitive, but we could get there. Do your kids have their own kids? Are our clients grandparents as well? We do know in this situation that one child works in the business, the other adult child does not, and one is still a minor. So very different needs when it comes to all three kids. There is a large distinction between what is fair and what is equal. Sometimes those are the same things, they're all in one, and other times they are not. Parents may just assume, for example, I have three kids, I'm going to split everything three ways, right? I hear that. It's a more old school mentality, and that would be equal. But would it be fair if one child wants to work in the business and another child wants absolutely nothing to do with it, and they wind up being equal shareholders? It might be equal, but it definitely might not be fair. And that fairness might become more important the more we talk about it to that business owner. Values differ, and of course, how assets are taxed differ as well. So what depends on what you leave behind. And there's also the minor to factor in. Do they also have any grandchildren? Do any of them have any more specialized needs? We really get to add value here with ourselves, but also pulling in the right professionals. This is going to be key. Once again, we want to collaborate. And truly, I usually see the insurance sale becoming more enriched when you get to collaborate with a lawyer or an accountant, for example, so that you're all on the same page, instead of often different silos and maybe offering advice that doesn't match, or maybe having one of those professionals second guess your advice because they weren't there at the table to discuss why it was meaningful. So very important here. We get to pull them in. We get to discuss things. For example, in this situation, estate equalization. Maybe we want to see an estate freeze here. Maybe there's a need to put the right trusts in place. And most importantly, to bring it all full circle, once we've talked about what matters and how they want it to look like, let's get that will updated. It's always going to go back to that. Whatever they want, we've got to make sure that it's reflected in that will. We got them to tell us the story of their lives, what they want to see when it's all left behind. Let's make sure that we help get them to see those plans take place, so they feel confident those plans take place in that up-to-date will. Now, to wrap up, of course, we want to ask the right questions, get clients telling their stories so we could do what we do best as insurance advisors, and that's provide the best advice. And we do what we do through offering solutions via insurance products. So I do want to showcase, although today's presentation wasn't on product, that RBC does have a full life suite to accommodate your clients' needs. Your term, for example, allows you to choose an appropriate term length between terms 10 to 40. So, for example, if you have a client with a 12-year business obligation debt there, and they would like a term length to match exactly. For example, a term 10 is not going to quite get them there. They might not see the need of paying term 20 rates. They're really specific that they don't want to go over, what the obligation is. We could go and put that term 12 in place for them, or term 33, for example. We have that flexibility. Also, we do have very competitive term large case rates. As many of you know, our term rates do tend to be very competitive to begin with, but once the face amounts kind of get into that 5 to 10 and over $1 million range, our cost of insurance becomes even more competitive. So definitely take a look at us there, as it's often necessary to get something with great value to cover some of those larger business debts via term insurance. We also have all three permanent options when it comes to conversions. So for example, the relationship might start with a term need, but over the years, they have permanent problems, right? Taxation, legacy. Let's show them a permanent solution. We have our T100 Universal Life and participating whole life for conversion. However, our Par Whole Life is available for brand new business as well. No need for a conversion needed. And I'll quickly mention, for those business owners between ages 40 and 50 that want to access their capital in a high cash value product, they want that flexibility. We are extremely competitive in our values. So check out our wealth product, especially if you have that 40 to 50-year-old. And for your estate planning needs, where you're showing a joint last to die, we are regularly 1 to 5 years younger on the joint age compared to our peers in the market. So once again, you have a joint last to die case. If you're in Ontario, give me a call. Whether you're east or west, call up your RBC wholesaler, or I could help put you in touch with them. There's a very good chance that we are going to show excellently for that. And last but not least, I wanted to say thank you so much to everyone who tuned in today. I know it was a bit of a different approach. Rather than look at hard facts, got a little bit more chatty about focusing on our clients and getting them to open up and to share their own stories. So circling back to facts tell, but stories sell. And having a client tell their story about their business, their families, their wishes, often gets them to sell themselves on why they need protection for everything we've built. So by asking the right questions, like the ones we focused on today, we could start with, do you have a will? Is it up to date? We could go from there, and it's going to open up some very robust conversations. And with that, again, thanks so much. And Leanna, back to you.
Thank you very, very much, Anna. That was a fantastic presentation. I really do think it was geared to all of our advisors. Doesn't matter whether you're dealing with the family, middle market, high net worth space, or our corporate clients. I think, we all need to focus on something that's not just investments and insurance, and having this discussion about estate planning and wills is very, very important, and the means through which, we can provide added value. So for those advisors that may not even have a lawyer kind of within your referral group, you might want to explore having a couple on hand that you can potentially refer your clients to in the event that they need one of those experts. So again, thank you very much, Anna, for your time. So again, thank you very much for spending the last hour with us. Anna, thank you for your time, and we'll see you all soon. Take care.